I still think that earnings estimates are too high for 2023, and there's going to be some more economic pain ahead, notably in unemployment rising.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. After a punishing year in 2022, the markets have had a great start to 2023. The S&P is currently up 8% for the year, and the Nasdaq has had its best start in 20 years, up 15% year to date. Is this the all clear? Is the bottom in and a better year for markets ahead? Or is this a classic bull trap, one that sucks everyone back in before the bear returns to maul everybody? In uncertain times like these, it's wise to tap the counsel of those with decades of long-term success in the markets. So today, we'll ask these questions of Thomas Thorton, former portfolio manager, senior trader, technical analyst, and now founder of Hedgefund Telemetry. And by the way, Thomas's portfolio was up 53% last year. That's a feat few others can boast. Tom, thanks so much for joining us today.
Hey, Adam, nice to see you again. Coming at a time where we have, just as we were mentioning, Powell speaking in about 5 minutes, and so it could be fireworks if I do this. It's watching the markets go either up or down crazy.
Great, I appreciate you coming on. Yeah, the absolute worst time to schedule this conversation. I appreciate you still coming on.
It's actually better. I'd rather do it this time than have to focus on what Powell's trying to tell the markets.
Okay, and maybe later on we can talk about, of dreaming of a day where the world doesn't hinge upon, the words of one man, and we can actually go back to, having markets just focusing on what companies are doing and which ones are better ones to invest in. But right now, policy still drives everything.
Exactly.
All right. Well, look, lots of questions for you, Tom. If we can, though, let me start with a high-level one. I like to kick all these conversations off with, what's your current assessment of the global economy and financial markets?
Well, let's start with the economy. I think the economy is staying pretty resilient, considering the Fed has raised rates as much as they have. And you have other central banks around the world, ex-Japan, that have also raised rates. I think what's puzzling to me is that the markets are trying to play, well, as Neil Kashkari said, a game of chicken with the Fed, and they're not necessarily believing the Fed that they're going to continue to raise rates. And I think that is ill-advised. We've seen some downticks on economic reports. We've seen downticks with earnings. I still think that earnings estimates are too high for 2023. And there's going to be some more economic pain ahead, notably in unemployment rising. And we're at 3.4%. And to think that the market is being bid up, believing that the Fed's about ready to cut rates later in the year is a little absurd to me.
Okay, absurd. All right. So, because you focus so much on the markets, let's just start with the big question here, which is the current rally warranted, right? Is the bottom, have we seen the bottom in 2022? I assume because you're saying there's sort of an absurd disconnect right now between market sentiment and what the macro data is showing. Maybe you don't believe so, but I don't want to put words in your mouth.
I've been saying, and I think we talked about this last time, that I think the market's going to be in a range for a while. I don't think we're going to see new highs on the S&P for a while, maybe years. I could be wrong, and if I'm wrong, I'll change my mind. But I think it's going to be in this range, like period of 3,500 to, it can even get to 4,400. I raised that up a little recently. But I think that the main thing is that I'm more concerned about the earnings downshift right now. And a lot of times we'll see, oh, it's better than feared. And sometimes the earnings are even much better than expected. So for example, Meta had really good earnings. They surprised everybody with some, positive news. They downticked a little bit on the spending for the metaverse, and they also are, threw out a $40 billion buyback, which
Doesn't hurt.
that doesn't hurt. That was very welcome. Apple, on the other hand, reported earnings. It was the first down year-over-year earnings report that they've had. I think that the market looked at that as, well, it's better than feared. You look at Microsoft, they had numbers that they beat numbers, and then their earnings call, they totally threw down terrible guidance for their cloud business, and the market punished the stock, and it lasted for about an hour. Amazon, the same type of thing, but that stock's still, on the downtrend. So you have all these cross currents right now, and I think that you're going to have this clean quarter. And I've been talking about Q1 as a clean quarter. Clean in the sense that we don't have China lockdowns, clean in the sense that we have supply chains coming back mostly restored, and we probably won't have, knock on wood, weather-related disruptions as well. We've already gone through almost 6 weeks, and we haven't had snow here on the East Coast. We had a ½ inch, and everybody was, overjoyed. But I think it's going to be a warm winter. The fears of the issues with natural gas in Europe, they've had a warm winter. That's dissipated. So right now you have all these real positive things that are on the horizon, and it's going to come down to, is there demand? And the Fed, when they raise rates, one of the measures that you see after that is that demand starts to fall off. Prices have been high with inflation, and then the rate hikes and QT as well should crimp demand. So demand is going to be the big metric that I want to watch for come April and into May with Q1 earnings. I think that's really, really important. The other thing that is probably the two big risks in the market is if inflation doesn't come down enough and fast enough. It's already started to drop. You see the CPI data has started to decrease, and that's really positive. But we were coming from such a high level that I don't see it dropping in the same magnitude. That's a risk, a high probability risk. The other bigger risk is if inflation starts to tick up again. And I can say that you can look at energy right now has been just hit so hard. And I think that you've had a lot of the bulls be very, very frustrated with, especially with crude, because they are looking at over the horizon saying that the SPR is going to have to get refilled eventually. And that someone mentioned once that it was like Joe Biden's going to walk into the Chicago oil pits with a sticker on his forehead saying, I need to buy, 200 million barrels of oil, and the price would spike higher. And then China reopening was supposed to also be positive for crude, and that's really not materializing. I still think China's reopening is going to be a stage type situation, and that will take time. I think natural gas is oversold, and I'm currently long a little natural gas. I think crude could bounce from here as well, but I don't have a high conviction call on that. So there's a lot of stuff that's happening this quarter that could be very positive, and everybody's hinging on what that one person, Chairman Powell, says.
All right. Well, look, great answer here. I do want to, my next question was sort of dialing through what trends you think are going to drive the market action most this year. You already named a few, so if I can just dig into a couple of them. You say that demand is going to be the big metric to watch here. Now, speaking about Powell, one of the things to me, it seemed that he took pains to say last week when the markets rejoiced, it kind of made me feel like the markets were hearing what they wanted to hear and not actually listening to Powell.
That wouldn't be the first time.
It wouldn't be the first time, absolutely. Where he said two things. He said, one, taming inflation is still my number one priority, right? Like, I'm not changing course. I'm not talking about stopping rates sooner than I've been projecting. I'm going to keep going. He mentioned multiple rate hikes, not just one more. So he basically said, look, my plan hasn't changed. And he basically said the 450 basis points of hikes that the Fed has done since last March, he said, we're just beginning to see the full manifest. That's just beginning to manifest now in the real economy, right? Because there's the delay factor between when the Fed pulls a lever and when you see it in the economy. And to me, that's Powell saying, hey, I told you this was going to require pain. and you haven't seen anything yet. You ain't seen nothing yet on the pain scale. It's just beginning to happen now because of this lag, right? So to me, it seems that Powell really is still committed to demand destruction, but he's feeling like we're going to start seeing a lot more demand destruction. He kept talking about disinflation. I think he mentioned it like 15 times. His tractor beam that he's intentionally trying to affect there on prices is working. And he's basically saying, again, you ain't seen nothing yet because everything I did is just beginning to hit now.
Yeah, the market didn't really pay much attention to that line.
Yeah, at all. So I guess my question for you is, and maybe I'll tie this to one of my other trend questions, but sort of, the risk of recession and the risk of a harder landing than this magical soft landing everybody seems to be, expecting right now. Do you think on the demand side, would you take the over or the under, I guess, since you're having to bet in your portfolio, which bet are you taking here?
Okay, well, I just want to mention one thing first, that financial conditions index, you can look at a bunch of different metrics. They're high. Well, actually, it's looser than before the Fed started to raise rates.
Than before the first rate hike. Yeah, exactly.
Yeah, and so that to me is pretty astounding. And I think as far as rate hikes, I think there's a bit of a thinking within the Fed that they may be downshifting to 25 basis point hikes for longer. They'd want to postpone the whole thought of we're about ready to start cutting rates again. I think that is really important. I don't think that they're going to cut rates unless the market has some dislocation. There's some geopolitical problem in the world. Hopefully
or some
not
credit event or something like that, right?
Yeah, and
that's
so
that's not bullish, right? I mean, that wouldn't be for reasons that would be bullish for stocks, right?
Well, I think, look, if we start to see credit events, and credit's been pretty resilient for the whole year. We haven't really seen a lot of things that have happened in the past that we typically would see. I mean, I'll get to the over/under on that in a second, but for people to think that at 3.5% or 3.4% unemployment, when you continue to see the jobs unemployment claims coming in under 200,000 per week, I think is really hard to swallow for me. I know that they have done a pretty good job on the non-sticky type of inflation, the transitory inflation stuff. Airline fares have come down a little. They may go back up. I just booked a couple flights and was a little bit taken back. You're seeing today, we saw that the used car Manheim index ticked up 2.5%. It's the first uptick since 2020. And I think that I think the Fed could be stalling out the future rate cuts by continuing 25 basis points. I read today that there's a Citibank analyst who said, don't be shocked to see the Fed fund rate, terminal rate at 6%. And you had Neil Kashkari out today saying that 5.4% is something that he could envision. Look, I think that the Fed chairman in the past used to have a pretty good way of jawboning the markets one way or another. And Powell fails in that in many respects. I think he wants inflation to come down, and maybe he thinks it is still, he's not going to say it, but it's still transitory. But wages haven't come down, those ticked up. You had a monster non-farm payroll number, which you can discount a lot of the seasonal factors and everything else that the non-farm payroll nerds look at, but it's still very strong in the labor market. So is the demand, will I take the under or over on demand improving this quarter? I'm going to take the under. And that's a hard call, especially if the market remains resilient and the equity markets remain resilient. Because I think that cash balances for consumers is starting to dwindle. We're seeing credit card usage tick up, and it's not necessarily they're out buying discretionary goods. They're buying staples, they're paying their utility bills, and credit card debt is at all-time highs again. So that's a dangerous little situation there. There's still a lot of cash in the system. There's still a lot of liquidity in the system. There's a lot of talk that the conspiracy theorists say that the Fed and the Treasury are funneling money to banks and to continue to have stimulus and liquidity in there. And I don't doubt that, because they have a lot of things and levers that they can pull to increase liquidity and decrease liquidity. And so
is that like discussion of like the TGA, like Janet Yellen?
Yeah, exactly. And now you have the debt ceiling, and there's a lot of press on the debt ceiling. And I tend to agree with Bill Dudley, former Goldman Sachs and Fed governor, who he said they should just eliminate the debt ceiling. And I tend to agree. I'm not for high debt, not at all. I think that it's a runaway train. But rather than every 6 months continue the politicians on both sides doing a kabuki theater,
right?
Everything's going to blow up, everything's going to be a disaster, and then all of a sudden, the last minute, they're shaking hands and they made backdoor deals, and right. It's all fine.
The charade that anything other than it getting raised was going to happen.
Yeah, it made no sense, and I think a lot of them. I also think the Fed, and I know this, that they have put together a lot of programs in case the debt ceiling bill doesn't get handled, and they will accept actual defaulted bonds because they just know that eventually it'll be paid. But that eliminates the 2011 sharp disaster scenario.
Okay, well, let's project this then. So if you think demand is going to be lower than the market's currently pricing in, I guess how bad, right? In other words, do we have a recession this year? Do we have a hard landing, or at least err on the side of harder versus softer?
Okay, a lot of people want to go to the soft landing, hard landing, recession, no recession. I honestly, it's going to take, it's one of the things that typically happens after you have these boom bust cycles is it takes a lot longer than 1 year after during a bust cycle. And there are a lot of things that I haven't seen that say, hey, we're going to be in a recession, partly because we haven't seen unemployment tick up. And that when that happens, that'll increase my belief that we will be in a recession.
Your conviction.
It may not be.
Sorry to interrupt, but as you answer, do you think we have entered a bust cycle? Are we in a bust cycle right now, or where do you think we are in the cycle?
I think we are.
Okay.
I think we are, because everything happens in quarters, not months or days. And the short term, as everybody is in this market, cycles take time to work out. And I still think that the markets can go, the S&P can go up to 4,400 and back to 3,500 and back up. And I hope to take full advantage of all those opportunities. I like that type of volatility. it works for me and my trading style.
Yeah,
But
and what's great, and sorry to interrupt, but because you think that the market may be range bound for a good while here, I want to make sure people don't think, oh, flat market can't make any money. You're basically saying with your style of approach, you can actually make a lot of money if you get the cycles within the range correct.
yeah, I'm a long short fund manager, and that's how I see the market. So I don't necessarily shorts. Well, actually, let me go back to the recession thing,
Sure.
because I don't want to get too far ahead of
I
myself.
kind of pulled you off it. Sorry. Yeah.
Yeah, you can't do that to me, Adam. So it's okay. Look, it's possible that we'll have a recession. I think that it'd be technically. I mean, they changed the technical term of recession last year, but I think that it's possible that we can be in a recession. And it might start to reflect in third quarter, and that's, once you get there, I mean, it's always a soft landing until it's a hard landing. And
Right.
you think about it when you're in an airplane and the airplane lands and it's like, oh, we made it, we're on the runway, we're good, it's a soft landing. But the brakes and the engines fail to stop the plane, and then it just goes right off the runway, and that's the hard landing. So it's when we get into a soft landing scenario and the recession's here and unemployment's ticking up, and it's if we get another dislocation in the market, then it becomes a hard landing. So it's for those that are saying, oh, we're definitely going to have a hard landing. I'm like, okay, let's just see where we go with that. And remember, if the Fed starts cutting rates, they're doing QT. They're trying to reduce their balance sheet. So that would sort of go against two policies working against each other. So I don't see that. I don't see rate cuts coming. But if, let's just say they stop QT and they start cutting rates, the economy could still be in a downturn, and the markets could still be suffering through more dislocations, even weaker earnings. Look, if unemployment goes up, then you're going to have a problem with a lot of different asset classes. You see consumer staples and discretionary start to weaken, car sales weaken, housing weakens. So that's kind of my view on the inflationary type of situation of what to expect. Let's not get too far ahead of ourselves and make big, predictions that I know the little steps that I want to see to be correct or wrong, and that's how I look at things. I don't want to go too far ahead and say,
Got it. You look at it more sort of incrementally. Yeah.
And I think that's the better way in this environment.
Okay. Well, clearly it's been working for you, given your track record last year. Let me ask you this.
And another thing, I had a great year. There were a lot of good opportunities on the long and short side, and I took advantage of them. I don't anticipate that type of a really strong year. I just want to be positive, but I want to caution. I'm probably not going to do what I did last year, and you get a few of those types of big years every 5 years or so. So I was really very, very proud of what I did, but it's going to be a tougher year.
As you should be. And as you and I were talking about before we turned on the camera here, look, nobody hits a grand slam every time they're at bat, right? But I'm curious, besides just your humility, is it more you're saying, hey, don't expect me to have a great year this year because of just general reversion to the mean? Or is it because you saw a lot of long short opportunities last year and you're just not seeing as many this year so far?
Well, to be blunt, I started the year off and I didn't get all the signals that I typically like to see at tradable lows. I covered a bunch of shorts at the end of the year. Took off a lot of tech shorts, and I was debating with myself whether to leave them on and go into the beginning of the year, but came in, started to I trade around things a lot, so I've been net short through beginning of the year, and I've had some winners on the short side. Energy hasn't been that great. I've had some earnings winnings. Some things go down. I was short Whirlpool and made money. I was short Amazon and made money into the earnings. I've been wrong on a couple as well. But right now I'm down to less than 1%, and I'm not in panic mode, but certainly just trying to navigate. And I think it'll be okay. It's a long year.
It will be a long year. We're just at the beginning of it. All right. Well, look, I want to dig a few more into the macro a little bit, and then we'll get back into sort of exactly how you are currently allocating capital, as well as your approach, because there's some important parts about your approach I want to make sure the audience understands. But back on the macro for a minute. I want to ask this question, and I don't want to be guilty of leading you, so I'll answer any way that's truthful for you. But first off, when you talk about the jobs data, I find the data hard to swallow, and have for a while, because the jolts, the payroll data really doesn't seem to square with a lot of other, I would say, the preponderance of other macro data that's out there, even some of which is related to the jobs market. But I don't want to get into the debate of whether the data is actually factual or not. But if you dig into it, it really does seem that like all the job growth that we saw in 2022 was part-time jobs. I think full-time jobs, depending upon when you measure it from, I mean, they were almost negative for the year. And so one could interpret that as a sign, not of a strong jobs market, but a weakening jobs market, right? Where people are getting forced to basically work multiple jobs to make ends meet, right? And of course, we've seen layoffs and all that type of stuff. And if you're expecting earnings contraction, which it sounds like you are still, I think that's still your base assumption for this year. When earnings get pinched, companies eventually have to start laying people off, right? They resist, but then they start laying off. And of course, we're seeing layoffs really jump here. And I want to combine that with the dramatic increase in the cost of living that we've seen, right? So inflation, no surprise to anybody, has raged the past year and a half. Everything costs way more than it used to. A lot of those inputs have gone up, right? You said we're seeing credit card debt spike, not because people are making a ton of luxury discretionary purchases. It's just because the regular basics of life cost a lot more, right?
Right.
So you've got that. You've got housing rolling over, which has a very important negative wealth of impact, because for many more households, their house is their biggest asset, not their brokerage account. Coincident with that is the rate hikes that have gone on have raised the cost of capital, both for consumers, right? Credit card debts at all-time high interest rates right now. Mortgage debts are more than double where they were a year and a half ago. But on the corporate side, cost of debt's increasing. And again, you can just do less with what's left over after that. So the preponderance of all that makes me feel that demand is going to take an increasing hit as the year continues on here, unless there's something exogenous, like, China reopening just gives a massive boost, of growth to the economy globally. But I think I heard you say earlier, we're not really seeing something that dramatic yet. So long-winded question, or long-winded way to say, do you have a similar outlook, or do you look at it differently, as less of a parade of horribles as I've just laid out here?
Yeah, that was quite a parade of horribles. Usually I'm accused of parading those out. Well, there's a lot. I mean, this is what's interesting. Every market is different. You kind of look back, and I've been doing this quite a while, and I've seen how bear markets start. I've seen the indicators when they start doing what they do. This one is a little different, and I'll mention one that you, in the parade of horribles, housing. Okay, so I am short housing ETFs, ITB and XHB. I'll tell you why. The home builders just reported pretty decent earnings, and they were in the better than feared camp. And the stocks are up. Some of them are up 40% in the last 5 months.
Yeah, and sorry to interrupt, but a number of them are like near all-time highs.
Oh yeah.
when they're having, in certain cases, like ridiculous cancellation rates. I think KB Homes had a 68% cancellation rate in Q4.
Yeah, I'm just looking to see where my good ones are right now. Yeah, so the thing is, first of all, I think the hope in the market was that interest rates would continue to drop, and we saw a drop from the 10-year above 4%, and it recently dropped under 3.4%, and it's currently at 3.65%. You're starting to see another uptick in rates.
Little creep, yeah.
And I think that the home builders are unique because they sold out of everything during the pandemic, and there was a big pull forward in demand for new homes, and so that was really positive for them. And they had low interest rates, and on the thought of low interest rates, I'll give the Fed credit on something, that they've created something that is absolutely a benefit to people and families, but it also created a problem going forward. And that's when you have ultra low interest rates for over 10 years. The majority of people that bought homes in that period have much lower mortgage rates than what they could get today, which that's great. In the previous periods, interest rates were higher, and when unemployment spiked, that really shook people out of their houses. They walked away from their mortgages, and that was, we know the end of the story there. But people are trapped in their homes right now. They can't get out of them because they have these low interest rate mortgages, and if they have a 3% mortgage and they're going to get a 6% mortgage, that's a pretty big number increase for a monthly mortgage payment.
Right.
So
when housing prices haven't adjusted accordingly to offset that.
Well,
right. If houses were 40% less as a result, maybe that math would work, but they're not.
Yeah, I think 40% is a big number, but I think you will start to see housing come down. One of the problems is you don't have a lot of turnover either. So that when you don't have a lot of turnover, you're not really seeing the dramatic drop in prices. And there's still, again, with all these people locked in their mortgages in their homes, they are not putting their house on the market to sell because there's no mobility to move to a new house, because prices are still high. There's no supply out there. And I don't want to pay I don't want to pay 6% or more on a mortgage. So there's a bit of a stall happening in that area. That's why new orders dropped, cancellation rates dropped. And just one of my good friends, Julian Brigden, brought this out to me the other day. He said, the new home sales data that is reported every month, that is data that the home builders give to the company that tracks it, or it's a government source. But that's when someone or a family will put a deposit down or sign a contract on a new house. So when you have all these big cancellation rates, that doesn't get reflected in the new home data going forward. So it will probably be down a third of really what is being sold and what is turning over. So when you don't have turnover, it's just like a stock or a bond. If you don't have a lot of turnover, you're not going to see a lot of volatility in price. So I think the home builders also had high wages that they dealt with. They had high material costs that they dealt with. And that's an area where I'm watching for, in the jobs data, layoffs within construction workers. Because if you start to see that happen, that's going to tell you that might be a pretty good signal that things are going to slow down. And
is there public data for that?
It's in the jobs number. You can see the manufacturing data, and they break it out, construction workers and.
Okay. It's in these monthly job reports. I'm curious, are you seeing any notable change in that yet?
Not really.
Okay.
The jobs data has been, it's perfect. I mean, it really is. I mean, maybe the whole story with Powell is we're going to lower inflation slower and keep the equity markets and bond markets hanging in there fine, not create some disruption, and allow the employment picture to remain perfect.
I'm
Maybe
sure that's their dream. Yeah. Do you think they could have
I mean,
succeeded it?
well, I'm just watching right now and I'm seeing a little bit of a spike in the market. So I'm sure Powell said something wonderful.
Okay.
We're never gonna hike again. Oh God.
All right. Yeah, you're right. I'm seeing a little bit of a jump here. So he must have said something that they liked, or at least could twist into hearing positively. Sorry for folks that we don't have the time to dig into what Powell's saying, but we'll do that in a future upcoming video here. One question for you on and to addressing this answer here on housing is and I'm assuming maybe you agree with this because you said you're short the home builders, or you're short these housing ETFs. I totally agree that there are a lot of people trapped in their homes, right? And so I've heard people say, and that's why prices won't come down. Nobody's going to sell, right? And I think, well, maybe the pace, maybe it'll take longer, but housing prices are set at the margin, as you know, right? And there are always some transactions that have to happen. Right? People die, they get divorced, they lose their jobs, they got to move for their job, whatever, right?
We just said it right there. You said it right there. They lose their jobs. That's one of the main reasons why people sell their houses. That's one of the main reasons. And in past cycles, that was really the key contributor to why people they couldn't sell their houses. They just walked away, and they were underwater in their mortgages. And
that's the jingle mail.
That's that. So if unemployment starts to rise, I think it's not going to be a good sign for home builders or a lot of other assets.
All right. Well, obviously your conviction is high enough that you're actively short right now, right? So
yeah, and after the big move, so I use indicators that I can track and have a pretty good indication that the buyers have exhausted themselves on the way up.
Okay. All right. And again, yeah, and that's one reason why people should subscribe to you and follow your work there, because you share all those indicators that you look at. All right. So we covered, I guess, let me ask one last question just on cost of capital. That's a lot more expensive than it was, for the past decade. How much fallout do you expect to see from that going forward?
Well, I haven't really seen a lot of fallout on that. And I think that there's a few things within the bond market, the credit markets with corporate credit. There's high yield and investment grade. The high yield issuance was so big in the last 5 years, and a lot of those companies issued debt that was covenant free. In other words, just trust us. And there weren't covenants that would say, if this happened, then we have higher risk of default. So that you're not going to see the early indicators that we've seen in the past credit markets, because basically when they die, they're going to blow up, and that's that. I mean, I can look at Carvana and Bed Bath & Beyond and AMC and all the others that have this, horrific debt that they have, but the stocks keep going up in meme-like fashion. But we haven't seen credit dislocate yet, and that's something I think the Fed is probably more attuned to. They want to make sure that stays intact. The other thing is there's a big rollover that's going to start in 2024, where these firms are going to have to start. It really increases significantly in 24 that they're going to have to refinance their debt. And again, everybody's talked about zombie companies. The cost of capital is going to be a lot higher, and maybe that's going to be when things come unraveled in the credit markets. So it's again, there's a long time frame of what's happening here, and it's that issuance when it has to roll. That's going to be when we really start to see the higher cost of capital hit those companies.
Okay, so it sounds like something you're concerned about. Sounds like maybe you're putting in that category of like, that's pretty far out. You're looking more at things incrementally in terms of how you're allocating right now, but it's a risk that you've got your eye on of like, according to the current math, that's going to become a problem at some point.
Yeah, it's going to become a current problem. It's going to become a problem in the future. It's not something that's going to hit suddenly. We'll start to see that occur, and so far we haven't really seen any of that problem. And that's another thing that's really kind of strange. We've had such a big equity market pullback, but credit's really hung in there better than I would imagine.
Yeah, and I mean, I'll just admit that's just sort of one of the things that surprises me, and I like to bring it up here just because it's one of those things that people can dismiss of like, oh, we thought it was going to be a problem, but we're not seeing it, so I guess it's not a problem. And the answer could be no, it just takes time to build to critical mass, right? And so anyways, I just want to make sure that folks are keeping on their radars. All right, last macro question, then we'll get to your market allocations. Geopolitics. You talked about this being a clean quarter. We probably thought Q1 of last year was going to be a clean quarter, and then Russia invaded Ukraine and upended everything, right? Is there anything on the geopolitical landscape right now that you're looking at in from your incremental viewpoint that you think is going to drive the action here? Or as long as Ukraine sort of stays where it is right now, we'll still have this sort of clean outlook?
Well, Putin's 4-day war that he expected has lasted a year now, and it certainly has taken a toll on the Russian economy. Obviously, the loss of life with Ukrainians and Russian soldiers is substantial. The risk I see, and hopefully, I'd like to be wrong on some things, and this is one I certainly hope I'm wrong. The West has been arming Ukraine. They're sending tanks that are going to definitely have an impact. They just keep this increasing volatility and that could occur. And Putin is such a mysterious person. You don't know what he's exactly thinking. And he's sort of caged here with his 4-day war that's turned into a 1-year war, and he's become a global pariah. And the risk is that he escalates this war, and the bigger risk is that the West starts to get involved with sending planes, sending bigger weapons. Putin responds with tactical nukes, as he ridiculously warned. These are little things that can become real big things in a real short period of time, and certainly the markets would absolutely hate that. It would just be a disaster. Bringing in, if the West got involved, it would. I just can't fathom how bad that could be.
Right, it's got super high tail risk.
Yeah,
I guess my question is it something that you're investing, that or any other geopolitical thing?
No. You know what? Those are fat tail risks. If things start to heat up, we'll probably get a pretty good warning signal. I certainly hope I'm way wrong on that. I think the China situation in the U.S. It's fractured relationship. This balloon is kind of silly flying over the U.S. It's a maybe maybe it was a weather balloon, maybe it was a spy mission. I don't know. I tend to think that I actually kind of wonder what the Chinese were thinking in this, allowing that. If the U.S. sent a balloon over China, it would probably get 2 miles in and be blown out of the sky. This is kind of a dumb misstep on China's part, unnecessary. Maybe it just went wayward. I don't know. I mean, when you have drones and you have satellites, you can track much more accurately everything. Why send a balloon that just goes with the weather pattern? I mean, it just makes no sense to me. So I'm not really overly concerned about what's happened with that. I think there's risk still with Taiwan, but those are ongoing. The other big political risk, perhaps, but central bank risk is what's going to happen with the Bank of Japan. They're going to announce a new leader who's going to take over in a few months. I think that is going to be something that could be really market moving, because Kuroda and his policies of the weak yen and the ability to have yield curve control, that's going to be put at risk. And I think that's something that needs to happen. But they're also the central bank that, if I was going to bet on a central bank blowing up one day, that one would be number one on my list. I just think their policies over 30 years have been incredibly reckless, with really no positive benefits to it at all. And I have friends that are macro strategists that say, oh no, it's great that they're destroying their yen. And it's also a political issue too, because I've heard from some people that have said that people in Japan are upset about the weaker yen that they've allowed to happen. And of course, excuse me, having a currency implode, but it's gained it's gained back some lately. And if they lose control and this weakens further, I think that's going to be a real thing. So side note here, the markets are spiking higher, and apparently Powell said nothing other than being dovish, and he had the opportunity to walk it back, but there you go. And I'm short some stuff in the market, long too, but this is another probably ill-forsaken type situation that Powell should have been much more measured. So just let the market go up, no problem.
Well, let me ask you this. I was interviewing John Hathaway the other week, and he said, it's like, I said, I don't think the Fed really cares where the markets go. I know there are people that think the Fed wants the market to go up because all its banker buddies and member banks, want asset prices to go up. But he was like, I don't think the Fed really cares where asset prices go. It just wants markets to be orderly. And so I don't know. I mean, maybe if he's right, maybe Powell doesn't really care about talking up or talking down the markets, just as long as they're not, breaking. I also wonder too if he has just sort of taken a laissez-faire approach, like, look, market, you do whatever you want to do. Like, I know this delayed impact is coming. Like, I know I'm going to win out here. Just takes hold from my rate hikes when they finally hit in full force. So you do whatever you want in the interim, but you're going to find out soon, what's really what. So I don't know. That's just postulating, but I don't know. Do you have a reaction to either of those two?
Well, I think the Fed does look at the markets, and orderly. The definition of orderly for them is when they go up, and not down.
Okay.
And that has a two-sided risk. When you have markets that go up like they did from 2020 to 2021, you had rampant speculation, and ultimately you blow up a bubble, it's going to pop, and it did. So I think that if the Fed is ignoring the markets and they have this mandate to lower inflation, there's a real correlation. When you have higher markets, obviously, you're going to have better employment data. You're going to have higher inflation because people have more money. They'll pay up
Right.
for things. And so again, just going back, there's two risks. The risk that inflation stays higher, and the bigger risk that inflation starts to uptick again. And maybe the whole point of downshifting to 25 basis points is that they're just going to continue to do 25 basis points for as long as they have to. And I think that is, in my opinion, maybe that's a way of for them to hold off on, by downshifting, hold off of by cutting rates. Maybe they just can continue to inch their way up and not have to cut rates until something breaks.
I mean, we'll see. That's what Powell is saying he's going to do. And honestly, let's just say the Fed stopped right now. They'd say they just paused and they just held it here for the rest of the year. Back to my earlier question, 4.5% is a much higher world than we lived in for the past decade. And that's going to be really depressive on growth in a way that we just haven't been used to. So anyways, all right, look, I'd love to, I could talk for you for hours, Tom, but I'm looking at the clock here. I realize we don't have too much time left. So I do want to shift to the market side of things. What do you expect the markets to do from here? We talked at the very beginning of the interview about how you think they're, I can't remember the word you picked. Was it absurd or something like that in terms of the disconnect between current prices and the macro data? But what kind of year are you expecting in the markets?
I wouldn't.
Our interview with Tom will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And if you're interested in signing up for Tom's excellent trading service, go to hedgefundtelemetry.com. And finally, if the challenging macro outlook that Tom has detailed in this interview is you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities that Tom has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Thomas Thorton.